Jonathan, it's almost a year since what I would regard as the most extreme macroeconomic move I've certainly seen in 15, 20 years of looking at markets. That time the Swiss franc suddenly revalued by 30, 40%. Now, I understand back then Lex was immediately looking for Lex angles, which means which companies are going to suffer horribly as a result of this. Anyone making in Switzerland and selling to the rest of the world were the prime candidates. So that means luxury, and luxury in Switzerland means watches and so forth. So I understand you've been looking at this sector today to see a year later how things have turned out. What's caught your eye?
Well, yes, as you point out, the Swiss watchmakers have a big problem with the currency, because in order to say that it's a Swiss watch, you have to make it in Switzerland. It's a labour-intensive process. All your costs are in francs. So 2015, very much a year to forget for the two big quoted producers, which is Swatch and Richemont. So both of them opted to defend market share rather than profitability, which obviously meant that their margins got squeezed. In fact, Swatch's full-year profits will almost certainly fall this year as a result of that.
Because presumably their margins, whatever they were before this market move, they weren't so high that 20% can be straightforwardly absorbed. Does this mean they went straight into losses?
No, they didn't go into losses. It's just reduced their growth rates, which for a sector that has grown long accustomed to very strong growth rates, largely on the back of the Chinese consumer, and with relatively highly valued shares, that's been quite a shock to the system. And of course, the Swiss franc thing came on the back of an already big problem for the luxury goods, which was the clampdown on luxury in China itself.
Yeah, social media was already pinpointing any official who seemed to have a suspiciously expensive item on his wrist.
That's right, and that's meant that the sort of buying of watches in that part of the world is now overwhelmingly driven by sort of ordinary middle-class consumers who are a lot more price sensitive.
So how have they responded? I mean, you say they've been keeping their market share. Presumably they need to cut costs too.
Yes, and I think it's fair to say in this respect, Richemont has been a little bit more successful than Swatch. Its balance sheet, its sort of working capital is more tightly managed, I think. And also Richemont has the advantage of being a little more diverse. So yes, it is a big player in watches, but it also sells a lot of jewellery and fountain pens and other hard luxury items. And those revenues from those have been doing quite well.
Any of them you fancy a good investment now?
I think both of them are probably good long-term investments, and they're both good companies, and they're both in sectors with very high barriers to entry. You cannot just start up a Swiss watchmaking business. But I think the issues in China about consumer spending power are not going to go away in a hurry. So I think 2016 could possibly be another sort of year to forget, really, for investors in watches.
Thank you very much, Jonathan.